Hello and welcome to this new edition of our investment strategy series. There is no end in sight for the trade dispute between the US and China, at least not just yet. This uncertainty is having a significant impact. Growth has slowed in all regions of the world, with the biggest falls in manufacturing activity in Germany, China, and even the US. Negative effects from trade tensions have also started to emerge in non-manufacturing activity. This has led us to lower our growth forecast for this year and the next. We don't expect a near-term resolution considering how intense trade tensions have become, and activity can hardly recover until a compromise is reached. Meanwhile, central banks' response have been substantial, but is reaching the limits of what it can do on its own. The Fed's first rate cut in over a decade prompted a wave of cuts in emerging markets, and the ECB is preparing a fresh package of easing measures to be expected in September. There is little doubt that monetary conditions will remain accommodative for the foreseeable future. This support is key for markets as it can help extend the cycle and supports valuation. But monetary policy alone is not enough to counter the trade-induced slowdown. In fact, now is the time for fiscal policy to join central banks' effort in supporting the economies. But while China continues to provide both monetary and fiscal stimulus to stabilize its economy, elsewhere, authorities are unlikely to roll out fiscal measures at this point. The US have very little firepower left, and Europe lacks the political will, particularly in Germany. So things will have to get worse, or even much worse, to convince government to act more decisively. Other risks, such as a no-deal Brexit, also suggest more volatile times ahead. So, how can we find the right balance between growth uncertainty and easy monetary conditions? Well, let's hear from Stéphane how investors can build resilient portfolios.
While markets have grown concern amid escalating trade frictions and no-deal Brexit prospects, they have also welcomed looser monetary policies. And so, the question on our clients' minds is, what is the correct portfolio positioning? On balance, trade concerns are weighing more heavily on markets, and as a result, there is a need for moderate risk exposure. Carry strategies such as corporate credit and emerging market debt in hard currency should perform well in the current context because central banks' policies will keep global yields low. The impact of protracted trade talks on equities is unclear, which is why we have created an asymmetric return profile by combining equities and long put options positions. Additionally, we are underweight in emerging market equities and small caps due to the sensitivity of corporate profits to the evolution of trade as well as liquidity concerns. We continue to carry a meaningful allocation to gold. Gold remains an effective hedge against geopolitical dynamics. Because of its inherent volatility, it must be tactically managed. In currencies, a long yen exposure remains part of a balanced portfolio. Besides, we've turned cautious on emerging currencies as their outlook hinges on the evolution of trade tensions. All things considered, there is a case today for rising recession risks, and it's unclear whether the markets will enter a radically different period soon. This uncertainty will persist as long as the trade dispute drags on, and at least until authorities decide to step up fiscal support for the slowing economies. This is why we've built portfolios with a defensive tilt. We cannot stress enough how vital agility and investment disciplines are in today's fluid market environment. Thank you very much for watching.